Hey guys, JC Parets here of allstarcharts.com, and welcome back to our monthly powwow where we go over some of my favorite charts that I think tell the story of what the market is doing in the current environment, sort of where we've been, so we can figure out where we're going. That's what we're talking about here today. So I'm going to try to get through as many slides as I can. We only have a finite amount of time, and these aren't buy or sell recommendations. This is strictly for informational purposes alone, but I hope it gives you some insight as to what we present to all of the investors that come to us for help identifying trends, looking for trade ideas, everything like that at All Star Charts. Again, I'm JC Parets, and I look forward to showing off some of my charts. Let's get into it. All right, so the first thing that I think is worth pointing out is what's going on in the Dow Jones Industrial Average, making new all-time highs, and the Dow transports are really nowhere to be found, right? Just really a series of lower lows, lower highs, and those are not uptrends, right? And notice how transports peaked in May. So as the industrials have continued higher, the S&P 500 has continued higher, the NASDAQ has continued higher, transports have not, financials have not, materials have not, and we'll get into that. And really, the whole party really peaked, really the pinnacle of the party when the DJ was really, really pumping the music. Everybody's dancing. Everybody's having a good time. That was back in February. Remember the SPACs and all the IPOs? That was the best things ever were. That's when the new 52-week high list peaked on the NASDAQ. That's when the advanced decline line peaked in the NASDAQ. And it's really just been deterioration ever since. And as you can see on the New York Stock Exchange, we continued higher into May and early June. And remember, there's a lot more international companies in the New York Stock Exchange than there are in the NASDAQ. In fact, over half of the largest 100 components and weightings on the New York Stock Exchange aren't even in the United States. They're foreign companies. So huge exposure internationally. So with that, you're going to get a lot more financials, a lot more industrials, and then those really peaked at that point. So, all right, so gold, treasuries, and Japanese yen, three asset classes that we look at as defensive areas, stopped going down in the first quarter. They literally stopped going down. Gold stopped going down. Treasury bonds have been going up, even Japanese yen. When money is fleeing, money's looking for safety, where is it going? It's going into these defensive assets, and we simply have not seen them going down. They've been going up or sideways at the very least. Needless to say, happening in an environment that the majority of stocks are struggling. And that's something that I want to make sure to point out. Here we're looking at small caps that have done nothing since February. Micro caps have done nothing since February. And I want to stop it there for 1 second and just sort of reiterate, this is a market of stocks, right? So if you point to a couple of large cap indexes, whether in America or in Europe for that matter, that have continued to make new highs, that's not really the definition of the market, right? There's a lot more to it, a lot more different market caps and everything like that. You might be a large cap developed market investor and you're like, yeah, that's the market. Fine. You're entitled to that opinion. Most people are not that, right? Most people are looking to potentially have international exposure because there are times when international stocks are doing great and there are times that they're underperforming. But the bottom line is it's a market of stocks and it's a global stock market. The best it ever was in February, right? And then you had sort of one more higher high in a lot of indexes where there was less participation into May, and it's just really been deterioration ever since. And it doesn't mean that the stock market needs to crash, but I think it's important to be aware as investors. I hear some people be like, hey, JC, you think the market's going to correct? It's like, what? What do you call the last 6 months? The market's been in correction. The average stock is down over 20% off its highs. And I'm not Mr. 20% is a bear market or anything like that, but you do hear that. So when the average stock is down over 20%, are you looking for a correction? Are you unaware that we've been in one? I mean, just look at the way stocks have traded. Look at your winning trades this year versus last year. Look at the biggest losers you've had this year versus last year. My suspicion is that they're going to be very different, right? Because we're in a different market environment. All right, so needless to say, small caps and micro caps both peaked in February and have been doing nothing ever since. Of the SMIDs, if you will, the small caps, micro caps, mid caps, anything non-large cap, it's really the mid caps that have held up the best. So they hit that Fibonacci extension target. By the way, if you guys are interested, email me and I'll send you a primer on Fibonacci and where these levels come from. But as you can see, the market respects them, so do we. So if we're above 481 in mid caps, I think that's super bullish. But if this does not turn into a bull flag and we start to fall, I think that's a big problem for markets. The S&P 500 on a monthly basis now hitting our upside objectives of 4420. Is the market going to respect these levels? I mean, it certainly has in the past, as you could see. So is the market going to care where JC draws his Fibonacci levels? Maybe, maybe not. But we're certainly going to be aware of them. And if the S&P is below 4420, the risk becomes down, no longer up. And it just so happens that the S&P 1500, which includes both the mid-cap 400 index and the small-cap 600 index, so all 1500 stocks, stuck below or right at that 1020 level, which is the equivalent Fibonacci extension to the S&P 500, right? So objectives met. Is the market going to respect those levels is still to be seen. But at the sector level, we've seen the deterioration, right? Industrial stopped going up in May. Material stopped going up in May. Financial stopped going up in May. And it's really been a sideways chop or down in some cases ever since. So the question, are things getting better or are things getting worse? They're not really getting a lot worse, but they're definitely not getting better. Internationally, we have seen some breadth improvement, but we're just not seeing that in the United States. And if internationally we're going to get going, you're really going to want to see the industrials really taking off. And if you're interested in these slides, folks, email info@allstarcharts.com, password September in the rain. So if you're interested in the slides, info@allstarcharts.com, password September in the rain. So within financials, some people aren't aware, but Berkshire Hathaway is actually the largest component in the financials index. It represents 15%. So Berkshire Hathaway resolving this consolidation higher is probably going to give us a lot of similar information to mid-caps, right? Mid-caps consolidating and resolving this higher is going to be really, really bullish. So Berkshire Hathaway looks awfully similar. So look for one to be a heads up on the other. Meanwhile, within financials, the leaders have been anything, capital markets related, broker dealers, exchanges, new all-time highs in the BDs. And let me point you to Morgan Stanley. This one comes from our Young Aristocrats report, which are stocks that continue to raise their dividends every year for between 5 and 9 consecutive years. Morgan Stanley is one of those. And if we're above those highs from 20 years ago, all in, baby, let's go, right? So, and I think that's bullish for the space. But, again, if Morgan Stanley's not above those former highs, you can't own it. So that's the level. And then industrials, right? Sticking with that cyclical theme, industrials doing nothing since May. Keep in mind that all 20 stocks in the Dow Jones Transportation Index are in the S&P Industrials. So this is the Dow Jones Transportation Index, not doing what the Dow Jones Industrial Average is doing. And all 20 components of the Dow Jones Transports are in the S&P Industrials, right? So hence the underperformance across the board. And this industrials consolidation is taking place at a very important level. So an upside resolution out of industrials, man, I can think of very few things. I mean, if there's one chart that you want to take away from this presentation, it's this one. When these things start going up, you're going to be making a lot of money long stocks. And anyone not long stocks is going to be losing a lot of money. My point, I think, is what's the rush, right? Let them get going. Industrials have such a diversified components list. I mean, just all kinds of different stuff in the industrials. You've got human resources and staffing companies. You got airlines, railroads, truckers. You got the delivery companies like FedEx and UPS, expediters, aerospace and defense companies, all the big engineering. All that is industrial. So because it's so diversified, that's why it's so correlated with the S&P 500, right? So then within this, within industrials, I'm looking at Quanta. So, if industrials are really kind of doing nothing, it's a big nothing burger in industrials. When you find some that are bucking the trend, I think that's really interesting. This is a contracting service company, just to show you just a wide variety of companies within industrials. This one comes from our Under the Hood report. So for those of you who are unaware, the Under the Hood report is a scan that we run that really just shows us an unusual increase in investor interest, whatever it might be, unusual options activity, big volume coming in, insider transactions. For whatever reason, more people are now interested in these stocks than they were a couple of weeks ago. That's the only thing it is. And then we dive in and then we hand select. the best opportunities from either the long side or the short side. Just because a bunch of lunatics are now paying more attention to XYZ doesn't mean we want to buy it. In fact, sometimes we want to short it, right? So we just want, if more people are paying attention to it, I want to see what all the hype is about. And usually it's nothing, by the way. Usually, like, we look at the chart, it's like, right? But every time we look through this list and look at the list, every time we look through it, we find some interesting names. Granted, every time we make the list, about half of them at least are already on our radar, or they're coming up on other scans, or we're just familiar with them because they're, they're popular names or whatever it is. But there's usually an interesting one. I'm like, I've never heard of that company, right? And that's how we find opportunities. So I think one opportunity, it comes in industrials, $16 billion industrial stock breaking out on a relative basis, really goes to show you. I mean, look how we're breaking out on a relative basis. And when you look at industrials, they are not, right? So this is the sheer definition of relative strength. If we're above 112, I like it long with a target up near 163. And this one coming from our under the hood report. One thing I find really interesting out of transportation stocks is that, traditionally, as we pointed to before, it's really the small caps that are the underperformers, right? Small caps aren't doing anything, micro caps aren't doing anything, and it's the large caps that are driving markets higher. But in case of transports, it's actually the opposite. Where we're seeing the strength is in small caps and mid caps, and the underperformance is in the large caps, which is so interesting because that's really the only place that we're seeing that. Just a kind of just a logical sort of explanation for the whole thing is the fact that the shipping companies aren't as big, right? They're just smaller companies, so they're not in the large caps and they are in the small and mids, right? The marine shipping, I believe, is the proper nomenclature. And then just to sort of reiterate how the market peaked it back in February, look at the IBD 50 index, which is just a bunch of growth stocks, right? Theoretically, some of the cheapest growth stocks that are making new highs, showing relative strength, all that stuff, and peaking in February. Emerging markets peaked in February. The IPO index peaked in February. Biotechnology peaked in February, and it's really just been deteriorating ever since. So one chart that we definitely want to watch is this IBD 50. Shout out Investors Business Daily. I used to read it daily when I was like 22 years old. It's one of the reasons I originally got into technical analysis. So shout out IBD. And new highs here, which we're flirting with, I think would be super bullish. I would probably say a lot about some of these other underperforming areas, I think. Biotech being one of them. Biotech hit our upside objective in February. You feed the ducks, and now we're back down to these former lows near 120. So if XBI is above 120, I got no problem from the long side. IBB, so XBI is the equally weighted biotech, and then IBB is the cap-weighted biotech, making new highs. And then this is more like it, right? We looked at the transports and how transports, mid caps and small caps are outperforming the large caps. This is really the way the world is working right now, where the large caps are outperforming the equally weighted version that is not as skewed heavily towards the large caps. All right. So within healthcare, the leaders have been medical devices, right? Medical equipment, robots that are performing surgery, all that stuff. Look at Intuitive Surgical, for example. Boston Scientific is an interesting one. Huge base, 16, 17-year base. If we start breaking out to new highs, for you cup and handle kind of people, right? I'm not Mr. Name That Pattern guy. But if you're going to name a pattern, I mean, this kind of looks like that. But needless to say, what are we seeing? We're seeing continued bumping up against this overhead supply. So if we're above those former highs from 2004, I think you buy it, right? In the meantime, you leave it alone. If we start taking out those 04 highs, I think you buy it. We're putting on a calendar spread for our options, an options trade today for a calendar spread, for example. So keep an eye out for that. If you can't find the options trade here, shoot me an email and I'll go ahead and send it out to you. All right, so from an intermarket perspective, just further, again, deterioration, looking at the Aussie yen, right, making lower lows, lower highs, high beta versus low volatility, also peaking in Q1. So, from the beginning of the bottom of the coronavirus, when things really got going in late March, April last year, and then really into the summer, it was a beta chase, right? High beta was outperforming the whole way over low volatility stocks, and then that stopped in Q1 when Aussie yen stopped going up as well. Again, risk on versus risk off from a currency perspective. Back to the under the hood report, some of the areas that continue to buck any sort of trend of any deterioration whatsoever has been software. And then what's cool about the under the hood report, so we know that because we're looking at like the software index, for example, making new highs. So it's like, all right, duh, software stocks are working. But when they also come up on the under the hood report, that's fantastic. Look at Varonis Systems, VRNS. If it's above 72, we like it long with a target up near 90. and then just software in general. And then those are all coming from our Under the Hood report, which we release every other Monday. So here's Canada reaching our upside objective. So like the S&P 500, like the S&P 1500, like consumer discretionaries and some of the others, achieving upside objectives. Is the markets going to care? I don't know. We're going to have to see. But if Vanguard Europe index is breaking out, this was a buy above 60, right? This was $60. It was support, resistance, and then we broke out. So that was $60. We're long. So the ultimate target is up near those former highs. So for me, any weakness back towards that level, we want to be buyers of Europe. Look at Germany making new all-time highs. Germany, new all-time weekly and monthly closing highs. Italy breaking out of a 12-year base. Now you're really, Germany's one thing. Germany breaking out is one thing. You're talking about quality equities, down when you talk about Italy, Spain, Portugal, Greece, those are the riskier areas. And if money's digging down and buying Italian equities, also a lot more financials exposure in Italy, for example. Sweden making new all-time highs. Finland, Lithuania, Estonia, all making new all-time highs. Something going on in the water up there. Whatever they're drinking and making them buy stocks. I mean, look at these monsters. Something's going on up in the Baltic. I mean, man, monsters, all of them. Estonia, Lithuania, Sweden, Finland, just absolutely crushing it. Look at these monster bases in Japan, right? Nikkei breaking out of a 30-year base. Toyota breaking out of a 20-year base. And then look at the EWJ. This is Japan ETF breaking out of a 20-year base. And then with that, I wanted to just reiterate something quickly. So what you see here, guys, is sort of an example of what we do every 2 weeks. We rip right through a lot of charts. Obviously, I'm not including everything that we did last night. These are some of the things that we're doing, right? We're looking internationally. We're looking on a sector-by-sector basis. We're looking at individual stocks within those sectors that are either shining and showing relative strength, like software, or that are deteriorating and showing weakness, things like transportation stocks, right? And identifying where we want to look to be long and where we want to look to be short. And then we supplement all of that top-down work with these bottoms-up scans. We're going to take a look at the 2 to 100 club in a minute. Today, the Young Aristocrats report drops, like Morgan Stanley, we mentioned, stocks that continue to raise their dividends every year for between 5 and 9 consecutive years. So we do this for premium members of StockCharts. So if that's something that you're interested in, make sure to email us. And then with that being said, if you are interested in the slides, again, email info@allstarcharts.com. Make sure to use the password, because I give a lot of presentations. Make sure to use the password September in the rain to make sure that you get this particular deck of slides if that's something that you're interested in. So I really, really do appreciate you listening in. And from an analysis to execution standpoint, we'll look at things like Nikkei priced in local currency. We'll look at an individual stock like Toyota, a big component, and then to be like, all right, what's the easiest way for a financial advisor to be able to put this to work, or an individual investor, or traders at hedge funds, right? It doesn't matter. We're looking for ways to express this thesis. EWJ is one of those. If we're above all those highs from the last 25 years, you got to own it, right? Look at Czech Republic, new highs. Poland, new highs. Budapest, new all-time highs. Mexico, new all-time highs. Argentina, pushing up against those former highs. So we're like, okay, what's going on in Argentina? First name that comes to mind is Mercadolibre, MELI, which is like the eBay, Amazon sort of situation down in Latin America. And if we break out of this base right around 2070, let's call it, if we're above 2070 in Mercadolibre, we want to be long. Now, again, we're still in that box, but if we break out of that, we want to be long Mercadolibre. Taiwan pushing up against new highs. What else is new? A lot of semiconductors, of course. Taiwan Semi always coming up on our scans. This is a $500-600 billion company, folks. We want to be long if we're above 120 with a target up near 170. Look at India. India's been one of the strongest markets in the world. New all-time monthly closing highs. I think 20,000 is in the cards for Nifty 50. And then within that, look at the banks. There's a $140 billion bank stock, HDFC Bank. And if we're above 73, I like this name long with a target up near 115. Look at Shanghai Composite. I mean, listen, you say a lot about China. China's been getting killed, all these things. But when you look at Shanghai Composite, does it look that bad? Downtrend, consolidation, breakout, ripper. Downtrend, consolidation, base, breakout, ripper. Downtrend, consolidation, base, breakout, You'd think a ripper's coming next, right? It doesn't look that bad, right? It doesn't look that bad. That's how I see it. But if the A shares are below 42, I think you leave that alone until you get a breakout above 42. But then just look at emerging markets. EEM, like 30-something percent, 35%, maybe 39%. A lot of emerging markets is China. So imagine if emerging markets break out of this 12, 13-year base. Is there anything more bullish than something like this breaking out of this base? But meanwhile, they're still making new all-time relative lows, emerging markets relative to U.S. stocks, still making new all-time relative lows, but that has more to do with the fact that the S&P 500 has been so strong than emerging markets on their own. So let me explain. So meanwhile, new all-time lows, and then look at The Economist magazine. This was last month. This was back-to-back covers where you got emerging markets and a rainbow going into a freaking trash bin. And then 2 weeks later, they come out with a Chinese guy stepping on all the technology and internet companies. Like, wow, like, is there any more pessimistic sort of a viewpoint from The Economist magazine? So, wow. So for me, usually by the time The Economist is printing out magazine covers, they're usually not early to the party, right? So needless to say, we think that the bearish emerging markets is probably a little long in the tooth, as they say. And then Alibaba's been a great short for us, but now our targets have been hit. Our targets were down near 160. Our targets have been hit. We move on. Great. We were short China. We were short Chinese internet. Fantastic. But what does that have to do with moving forward? Our targets are hit. The Economist obviously got the memo, right? So I think word has gotten out. So where have the casualties been? And you could really see the difference when you compare Chinese internet with Chinese technology. So notice how Chinese technology is finding support right at those 2018 highs, right? Which is, right, former resistance turns into support. Classic polarity. But when you look at Chinese internet, it did not do that. And then when you look at the components of K-Web, which is Chinese internet, versus CQQQ, where you're going to see is a lot more JD, you're going to see Alibaba, which you're not going to see in Chinese tech, which is why it's holding up so well. So there's your answer. But overall, global breadth has definitely improved. In dark blue, we're looking at the new 4-week highs. In light blue, we're looking at new 4-week lows, or lack thereof, with expansion globally in 4-week highs and in 52-week highs as they continue to push against those 2001 levels, and then just a lack of new lows, right? 4-week lows, 52-week lows. We're just not seeing any lows. And then when you zoom out and you really want to know what's going on, look at the All Country World Index, ex-US is VEU. If we can take out this monster base, same thing with EEM that we just discussed, I think that would be, wow. That would be, very few things can be as bullish, right? So we're looking for breakouts here, breakouts in the US Industrial Index, XLI. If we get those, we're probably off to the races. I just don't think it's going to happen tomorrow, so be patient. So the 2 to 100 club dropped last week. This is where we're looking for the next $100 billion companies. Do you want to find the next $100 billion companies? Because I do. So what we did was we basically did the math. We have the right industry groups, so we're very specific with what industry groups we allow in the 2 to 100 club, and then market capitalization between 2 billion and about 35 billion. So we still have room for it to triple before getting to 100 billion. So the bottom line is we are making it really, really hard, almost impossible for the next $100 billion company to not come from this list, right? So that's really the deal. And then this is the most recent list. As you can see, there are very specific industry groups like software, data companies, medical equipment, the types of stocks that can scale from 2 billion to 100 billion. You're not going to find utilities here, right? You're not going to find consumer staples. You're going to find solar stocks, cloud computing, software, internet. You're going to find the types of names that can scale. Yandex is one of those. This is basically, it's a Russian, Twitter, Uber Eats, right, sort of situation. And if we're above 76, I like it long with a target of 108. That's Yandex, YNDX. This one coming from our 2 to 100 club. But we only want to be long if we're above 76. And then look at Cameco, getting into commodities. We're going to talk about how just commodities are just not loved. Cameco, look at uranium, really breaking out. Uranium futures making new highs. If Cameco's above 22, I like it long with a target of 44. Going down the cap scale, look at NexGen, NXE. If we're above 520, I like it long with a target up near 8. And then just the most hilarious thing ever is just the lack of ETF fund flows into commodities. These are ETF flows this year. Right? And what you see is nothing into commodities. And what some of you might say is, well, JC, there's no ETF flows going into commodities because there aren't any commodities ETFs, right? You got DBA, you got DBC, you got a couple sprinkled around, right? Outside of GLD. That's not really a commodity, it's a currency. So there's really no exposure to commodities other than GLD, right? And a couple of those others that I mentioned. So my point is, if there was real demand for investors to invest in commodities, don't you think these ETF companies would be giving them ways to do it? The ETF companies are not in the business of helping you make money. The ETFs are in the business of creating products that people are going to buy. And if there was demand for those products, they would be creating them, right? That's my point. So needless to say, nobody's investing in commodities because somewhere along the lines, people forgot that there were 3 asset classes. It's 3 asset classes, folks, not 2. It's not just stocks and bonds. Stocks, bonds, and commodities. Meanwhile, here's an equally weighted commodities index that we came up with. This includes all of them on an equally weighted basis. So it's not just energy skewed like the CRB index. And this looks like an uptrend to me, right? Here's that DBC. Here's that ETF. Looks like a consolidation within an uptrend to me. You know, new recovery highs for the CRB index. Oil continues to push up against those highs, right? Oil's still stuck below 76. So I think you leave it alone while it's under 76. But I think ultimately we see oil. I think ultimately we're going to see oil near 100, but we want to buy a breakout above 76. Natural gas, basically hitting our target as we speak, as I make this video. We want to feed the ducks. Can it go higher? Sure. But mission accomplished, right? The idea was to buy support down near all these lows from the last 20 years with a target up near 5, right? Mission accomplished, right? If you made that trade successfully, great. For me, I'm out. Let's see if we get a breakout above 5, if we hold that, but that's another trade and we'll reevaluate if and when that happens. Gold still stuck below all that former overhead supply. I don't know why anybody's in a rush to buy precious metals from any sort of intermediate to long-term perspective. This is, a downtrend to sideways trend at best. You could really see it here. Could it be a multi-year base that all the gold bugs keep telling us about? Sure. But why do we have to buy it before it breaks out? Like, don't you, right? Do you want to buy something like here or here? Do you want to buy the breakout? Like, let's go, baby. So we're waiting for that breakout. Meanwhile, gold continues to underperform stocks as gold is making new 16-year lows relative to the S&P 500. And you can really see it when you zoom out 10 years. Look at the Qs, S&P, small caps, just incredible performance. And look at gold and silver. So anybody over the last decade that told you to buy that garbage, was obviously wrong. So again, if you're interested in the slides, info@allstarcharts.com. Again, make sure to use the password September in the rain. Look at the all-time lows. The GLD fund has never been worth less relative to the NASDAQ, right? It's never been worth less. So I think where we really want to focus is in copper, right? If copper can break out, because the other ones, look at coal, aluminum, steel, tin, they're all ripping. The Baltic Dry Index, obviously showing us there's a lot of demand for raw materials to be shipped. Look at lithium making new highs. We still want to be long. Rare earth metals. That's really where I think that we want to look in those areas. So we're going to skip over currencies and interest rates today to get over to some of the cryptocurrencies. I know in the last few seconds, we could talk about it. Under no circumstances do we want to be long Bitcoin if it's below 46,000, below that, and the risk is down, not up. We only want to be long Bitcoin if we are above 46,000. Look on a monthly basis, Ethereum making new all-time monthly closing highs. And then relative to Bitcoin, same thing. The strength there remains. The potential flippening, where Ethereum is worth more than Bitcoin, the trend is heading towards that. So there's no reason, there's no evidence that suggests that that's not going to happen. I'm not saying it absolutely will, but the weight of the evidence is pointing to that's the bet that we want to make. Cardano, all-time monthly closing highs, great, but under no circumstances do we want to be long Cardano if we are below those May highs, right? That's the level. So it's no-go zone below 2.5. Above 2.5, I like Cardano long, but not below that. And finally, Algorand. If we're above $1.80 in the algo, I like it long with a target up near 250. That's the target. Long above 180, target 250. And if you're interested in the slides, guys, info@allstarcharts.com, and make sure to use the password September in the rain. I am JC Parets of allstarcharts.com. I hope you enjoyed that. And if you have any comments or questions, shoot me an email. Thanks, guys.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.